Thank you, everyone, for joining us today. Is the sound okay, Shura?
Yes, it does. Thank you.
Okay, thanks. This is an event that's co-sponsored by the Abu Dhabi and Dubai AmChams. So I'd like to thank, I'm Charles Laubach. I'm chairman of the Legal Affairs Committee of the Abu Dhabi AmCham, and I sit on the board as the secretary. But I'd like to thank everyone, all of our friends from Dubai for helping us organize this. And I'd like in particular to thank as well all the other AmChams around the Gulf from Bahrain, Kuwait, Oman, and Qatar who are joining us, as well as the American Women's Association in Qatar. So thank you for joining us. I'd like to introduce briefly our speaker today, Affan Qadr, who's with Expat Global Tax. Affan is a qualified IRS enrolled agent registered with the IRS. He works as a senior U.S. expat tax manager with Expat Global Tax in their Dubai, UAE office. He has experience of over 15 years with individual U.S. tax compliance matters, consulting for U.S. expats and foreign nationals. Before joining Expat Global Tax in Dubai, he worked with accounting firms such as PwC and EY in their U.S. and international offices. Affan specializes in providing tax help to U.S. expats based in the Middle East. He helps them with filing accurate IRS returns while maximizing deductions and exclusions that are available to them. He provides advisory services for tax optimization and strategies. He represents clients in front of the IRS in matters such as audits and other challenges. He assists individuals with business ownerships outside of the U.S. and with their tax compliance issues. He assists delinquent tax filers successfully filing under the amnesty programs and exit tax filings for U.S. citizens and long-term residents who have relinquished their citizenship and residency. So with that, I'd like to hand it over to Affan, who's going to talk to us about the obligations of American taxpayers who file from overseas. Affan, the floor is yours. Thank you.
Thank you, Charles, for the introduction. I welcome all the other participants to this webinar. I know for majority of you, it is at the later part of the day. And I know this is the time where I'm sure all of you, most of you must have already started, preparing to file your taxes. So I think this is the right time, I guess, to go over this webinar. So just having said that, I just want to jump into the agenda, what we have for today. So we will mostly cover the relevant topics relating to the expats. We'll start with the U.S. taxation overview. So in that, probably we'll talk about the filing requirements, some of the misunderstandings for the expats when they come in and work in the foreign country. We will also talk about the foreign earned income and housing exclusion that expats are generally eligible and exclude, their income. And then we will also talk about some of the other filing requirement other than the tax return, which is called the Foreign Bank Account Report FBAR and FATCA. We will also touch base on the state taxation part. Again, there will be some concerns in the expat community when it comes to state taxation. So we'll try and talk on that front as well. And continuing with that, so we'll talk about the filing requirement for someone with ownership in a foreign country, foreign corporation, and foreign partnership. So we'll touch base on the the compliance aspect of it, the tax treatment, all those things, and then. So we will also talk about in this webinar, we include this topic for the delinquent, the filing option for delinquent tax filer. This is for people who have never filed their taxes, and there are certain options that are available for them which they can take advantage of and then become compliant. Lastly, I think towards the end of this webinar, so we will touch base on some of the key updates relating to 2021 US tax filing. And finally, we'll talk about our firm who we are, what we do, how we can help, our services. So we'll talk about that. And then finally, we'll have a Q&A session for, to answer your questions, your burning questions that you may have. If you, again, we will try to, answer as many questions as we can. But again, if you have any other specific issues to discuss, we will share our contact details. You can always reach out to me, and then we can probably talk about that. Any specific filings for you, any specific issues, or anything, any other questions you may have. That being said, I think let's move on to the first topic of the webinar, which is the US taxation overview for the expat. So generally when somebody comes or lives and works outside of US, they will have the questions whether, so now that they're moved abroad, so do they need to file any taxes, or do they need to file the tax return? So once they move out of the US. So that's one of the common questions which they will have. And then there will be some other misunderstandings, like I think they will be aware, most of the expat would be aware of the, the foreign exclusion which they are eligible for. And then if they say that, some of them, they think if they make less than that exclusion amount, they don't have to file their taxes. So these are, I think, some of the burning questions and some of the misunderstanding they will have when they move out of US. So the answer for, so anybody, so when somebody moves out of the US, they have to file their tax return if they exceeds their income threshold. So we have listed in the slide, so depending on the filing status, so if what their income should be in order to file the tax return. For the single filers, so if their annual income exceeds 12,550, they will have to file, they have a filing requirement, and then they need to file their tax return. And then for joint filers, it is 25,100. For head of household, it is about 18,800. And then married filing separately, the amount is just $5. So if you meet this threshold, if your income exceeds the threshold, first thing is you have a filing requirement. And then the next aspect comes of it is how much can you exclude? What is the criteria? That's the secondary. In order just to clear the misunderstanding about the exclusion aspect of it, if you need to file a tax return in order to claim the exclusion. So without filing a tax return, you cannot claim the exclusion. In the eyes of IRS, so even if you make $50,000, which is, let's say, for example, 75,000, which is less than the exclusion amount. So in the eyes of IRS, that's still the taxable income if you don't file proper correct forms to claim the exclusion. So that's something you need to watch out for. If somebody is new to the region, I think they need to understand this aspect of it. And not only this, I think the filing now, I think with this Corona from past 1 year pandemic situation where we are, so IRS started to give these stimulus payments. So for some, the filing, they need to file just to claim the refunds. If somebody have not received their stimulus payments, let's say this year for 2020 especially, if anyone did not receive the third stimulus payment, which is $1,400 per person, so they can file a tax return to claim that refund amount. So that's another reason to file to get the refund. Again, so all the Americans and green card holders, they are subject to worldwide taxation on worldwide income. It's not that residency-based taxation where it's unlike most of other countries. So where if you are outside of that country, and then if you're not resident, it's mainly based on the residency where you don't have to file or report the income from other, jurisdictions if you are out of that country. But with respect to US is one of the country where which probably all the income. US is one of the country which works mainly on worldwide income. So if you irrespective of where you earn or where you live and where you earn, you have to report your worldwide income on your tax return. And then, so that's the rule of thumb. So your worldwide income needs to be reported first. And then if you're abroad, if you're outside of US, then you start looking at what tax benefit I need to claim or I need to look at. Something like exclusion, what are the deductions what I have, what are the credits which I can claim. So those things comes later, but rule of thumb is your worldwide income is taxed irrespective of whether you are in the US or whether you live and work outside of US and wherever you earn. Okay, Shija, can we move to next slide, please? One more, please. Okay, so this is one of the important and interesting topics for all the, mainly for all the expat that they would be interested to know more about as well. It's how much, so if I work outside of US and if I need to report all the income, my worldwide income, what are the tax breaks I have? So one of the tax breaks, what you have is the income exclusion and earned income exclusion and housing exclusion. Provided there are certain criteria which most of the expat would meet, so they can exclude of up to 108,700 per person, per spouse. This is for 2021 tax year. And again, and then the housing exclusion amount, so can be, it depends on which city you live in, because IRS has different limits for different cities. For example, for Abu Dhabi, the maximum limit for housing exclusion is 49,687. And for Dubai, it is 57,174. Likewise, so for Riyadh, it is 40,000. And for Bahrain, it is 48,300. And for Doha, it is $45,888. And then if your city is not listed for all the others, mainly where the city is not listed, so it is 32,610. And again, just to bring your attention, with respect to housing exclusion, there's a base amount which is set by the IRS. So that's about, I think, 17,392. That's 16% of the income exclusion amount. So what IRS says is, up to this 17,392, you cannot, they will not get any benefit for. Let's say if you pay 50,000 in rent, so your exclusion will be 50,000 minus 17,392. So that will be your housing exclusion. And when I speak to my clients, some of them will have, they ask, is this, if the earned income exclusion of 108,700 is per spouse, then do we multiply by 2 and then do we get the full exclusion, the full amount as exclusion, irrespective of how much the spouse makes? The answer is no. Yes and no. So yes, for example, let's say it's higher of the amount earned plus, for example, let me just explain this to you in an example. So if one spouse makes $125,000 and the second spouse makes, let's say the same amount, let's say $125,000. So in this scenario, yes, you both are eligible for 108,700. So if you multiply this by 2, so you get the total 217,400. That will be your exclusion on your 2021 tax return. In the second scenario, let's see if one spouse makes $125,000, the second spouse makes $75,000. So in this scenario, the first spouse, the primary spouse, will get to exclude the full exclusion of $108,700, but the second spouse, who earns about $75,000, the maximum exclusion will be $75,000 for that particular spouse. So it's not that the unused exclusion for the other spouse can be utilized in the same year. So just to clear any misunderstanding on this. Okay, so now what are the criteria? So now we know that the expats are eligible for this earned income exclusion, housing exclusion. So let's just quickly look at the criteria which they need to meet in order to claim this exclusion. So the first thing is, of course, it's only for U.S. Citizen and resident alien, especially. So that will include the green card holders, and they have to be U.S. citizen or a green card holder. Second is their tax home needs to be in a foreign country. So IRS considers the tax home to have shifted to the foreign country if the employment there is expected to last for more than 1 year. So that's the tax home part of the criteria. And then lastly, they need to meet one of these two tests, so which we have listed down here. So that's physical present test and Bonafide resident test. So under the physical present test, so the taxpayer needs to be in the foreign country for at least 330 full days during any period of 12 months, 12 consecutive months. So that means they can visit US for about 35 days and still claim a full exclusion. So this is one of the questions which we get very often, that then each year somebody, how many days can I spend in the US and still claim full exclusion? And then one thing to keep in mind, this 330 days should be full day. That means any partial days is not counted towards 330 days. So if you arrive in the foreign country, let's say in the afternoon, so that day is not counted towards this 330 days. So maximum you can spend time in the US during the 12 months period will be 35 days. So to qualify for to qualify under physical present test. And then the Bonafide resident test is slightly different. It's just that you need to be a resident, Bonafide resident of a foreign country for an uninterrupted period that includes a full tax year. So you need to have a residence in a foreign country, and then you should have spent one full calendar year in order to be eligible or in order to qualify for this test. So the difference again here, we get the questions under this test. So how many days can we spend in the US and still qualify for a full exclusion? So here the answer is there is no set number of days. It's just that your trips back to the US should be temporary or for personal purpose or vacation only. So the moment you move back, let's say if you're moving back permanently to the US, that doesn't count. So it's only, as long as your trips back to the US, it can be more than 35 days or 40 days, 45 days. But again, as long as those trips are temporary, you don't have to bother, but you still be eligible to exclude, full, you still be eligible to get the full exclusion. And okay, so that's about the Bonafide resident test. Okay, so moving on to the next slide, what we have, that's one of the important, again, not everybody. So most of the expat, whenever they move out of the US and then start living and working in a foreign country, so they will be either they will be thinking about either their federal tax return filing requirement or state tax filing requirement. But they may not everybody would be aware that they will have to file something called foreign bank account report and the Fatca forms. So these filings generally does not impact or does not result in in any tax liability. These are just for disclosure purpose, but non-filing of these forms can attract very steep penalties. I think we have listed a section down there. What could the amount of penalties for non-compliance? So it's very, very important that the expat are aware of the foreign aspect of their filing requirement. Other than the tax returns, these forms are very important, to be, and they need to be compliant on this. And these are very risky forms for if you end up, missing out on filing these. So there's a big risk of you being penalized by the IRS. Okay, so so what are these forms basically? So this is just to, if you have a certain foreign financial account, of course, I mean, anybody who goes outside, I mean, they will have some kind of account, financial accounts like bank accounts, investment accounts, or retirement accounts in the foreign country where they live. So, so you need to look at the filing threshold. So what the highest balance is what you have. So the filing threshold to file the FBAR is this $10,000. If the aggregate value of all the foreign financial accounts exceeds $10,000 at any time during the calendar year, that means they are required to file this FBAR for that particular year. But again, there will be, I mean, I see whenever I speak to my clients, I think first and they will have some misunderstandings about the filing threshold as well. So for example, if some, just to make you understand when you meet this threshold. So this is, we talk about the aggregate value. If somebody has 3 different accounts and let's say if the aggregate value of all the 3 accounts exceeds, let's say if one account has $3,000, the second account has $6,000, and the third account has, let's say, $5,000. So all the aggregate value of all 3 accounts is more than $10,000, but each account is of course less than $10,000. Each account has, the value of each account is of course the less than $10,000. So in this case, you have a FBAR filing requirement, and all 3 accounts needs to be reported. I mean, I get questions like, okay, so I have 3 accounts. One account value is, let's say 50,000. The other 2 accounts has less than 10,000. So do I need to report all the 3 accounts, or should I just report one account which has more than 10,000? And again, the answer is you need to report all 3 accounts. So if you meet the threshold, you have to report all 3 accounts, irrespective of the account balance in each account. Even if the account, if any account is a dormant account, even that account needs to be included, as long as it is open and it is active. So you still need to report even that account. So like, I think the examples already mentioned there, foreign bank accounts, it could be checking account, savings account, deposit account, any other deposit account, and then foreign investment account, if you have one, any retirement or pension account, If you have any life insurance, all those things needs to be reported on FBAR. And other than FBAR, you also have something called Fatca filing requirement, which is reported on the form 8938. So the only difference is FBAR is filed separately and then it goes to the FinCEN department, Financial Crime Enforcement Network. And FATCA forms goes with the tax returns. And then it has different filing threshold again. So for the joint filers, if the value of the aggregate value of all their accounts on the last day of the year, is 400,000 or more, so they have filing requirement, or 600,000 at any point during the year, the highest value of all the aggregate highest value of all the accounts. This is for the joint filers, this threshold, and of course for other tax filer like single MFS, married filing separately, or head of household. So the threshold is 200,000 on the last day of the year, or 300,000 at any point during the year. And some of the, again, so all these, all the accounts, what is listed up there is the foreign bank accounts, foreign investment accounts, foreign retirement accounts, insurance, all those needs to be reported. In addition to that, let's say if you have, if you own any foreign stock, if you own a foreign stock outside of US, and then that's not, held in any financial account, that needs to be reported on the 8938. And so that's the difference between the FBAR and FATCA. And just to talk about a little bit more on the penalties side. So we have listed the the current penalties here. So it's 12,921 up to 50% of the account value per account per year. This is again for the non-willful violation. If IRS determines that the non-filing of FBAR was due to willful violation, then the penalties can be 10 times of, so what is listed here, which is, it could be $129,000 per account per year. So, so that's on the FBAR and the FATCA. Again, on the FATCA, the penalty is 10,000 per year per account. So the takeaway is you cannot neglect this, and this needs to be filed parallelly with your tax returns. And one other thing which I want to mention here, all the financial institutions outside of the United States, they have an agreement. Most of them have an agreement with the IRS to share your bank account information with them. So they have to be compliant. I mean, they have their own reporting requirement each year to the IRS, which they will submit your information. So IRS will have your bank account information details, and they would be expecting parallelly from you to, for these reports. So yeah, just the key takeaway from this slide. So just ensure you file these tax forms on a timely basis, accurately and on a timely basis, to avoid any, the potential penalties from the IRS. Okay, sure. Can we move on to the next slide? Okay. Again, whenever I speak to people here or expats community here, and one thing which they will not be aware of, or which they will be confused about, is about their state tax filings. So when they move out of the United States, let's say somebody moving out for the first year, or somebody living outside of the United States for many years. So do they need to worry about their state tax filing? Let's talk about somebody, who recently moves. So what they need to be looking at when it comes to state. So there are, as you all know, so there are many states, where people can come from, and some states are very flexible states, and some states are very strict states. Like, for example, California is very strict when it comes to breaking of any residency. So as Massachusetts and New Jersey is another state which is not the easy state to break residency. So they go to that extent. Even if you use the California address on the federal tax return, sometimes they issue you a tax notice on that you have used California address. So where is your tax return? And of course, the majority of the states, I mean, they allow you to break residency. So for some of the things to consider, whether you need to file a state tax return or not. So for example, like if you move out of Illinois for that particular year, and Illinois is one of the easy states where it allows, let's say if you're going for a long-term assignment, or let's say if your intention is to live outside of the US for a good number of years, so they allow you to break your residency. And there are, again, in every state, so rules for every state are different. So some of they look at, you need to consider all the aspect of it. So one thing which state always look at is, so what ties you have with that state. If your spouse, if you're going alone for an assignment, or if you're leaving your spouse or dependents back to the state, or if you're spending significant time in the state. So those kind of things which they look at. So it's mainly on the intention. If your legal residence or domicile still is in the state, then you have to file a full year state resident return, even though you're outside of that state. So it's not that state answer regarding what state tax return you need to file. So it depends on each situation, what kind of situation you have. Depending on that, you need to analyze and then talk to accountants and see what state filing you need to, what return you need to file for state. Like I mentioned, some states do allow to break residency. I think it's mainly on the intent as well. I think some of the you need to look at your action. I mean, your intent is basically important, and then some of the actions like closing of your bank account. Let's say if you move out of the state. Let's say if you dispose your property before you move out, or if you convert, let's say if you have a property and then you convert that to rental, that's an indication that, okay, so you're going for good and your intention may not be to come back. And maybe let's say if you close your bank accounts, or if you cancel your voter registration, these are some of the acts which will demonstrate that your intention. So based off this, probably you can, decide on what returns needs to file for that particular state, for that particular tax year. So again, when you determine what tax returns needs to be filed, let's say for if you're filing a resident return, of course, you'll have to report your worldwide income for that particular year and pay taxes on that. And then if you determine you need to be filing a non-resident or a part-year resident. So non-resident, it's only if you're filing a non-resident state tax return, means you will only be reporting the that particular state source income. And again, just coming back to this point, let's say if you are living outside of US, but you have a rental property in that particular state, you will have a filing, you'll have to file a non-resident return, to report the rental income and expenses from that particular state. That's one aspect where even if you're living outside of US for many, many years, but still this is one of the reasons where you'll continue to file a non-resident state tax and just to report your rental property in that state. Okay, so I'll just quickly touch base on some of the other, information relating to states. So some states does not have, income taxes like Florida, Washington, Texas, Nevada, South Dakota, Alaska. These are some of the states which doesn't have any income taxes. If you are from this state, so you don't have to worry about anything about the state filing. So there's nothing to be done. So, and there are a couple of states, New Hampshire, and I think if I remember correctly, it's Tennessee, which only taxes the interest and dividends. They do not tax any other income. So if you have any source, like a interest and dividend from that particular state, so probably you'll have to file a tax return if you meet the filing requirement. Okay, so again, when it comes to tax rates, so it varies from state to state. Some state has, I think the rates are up to, California taxes at, I think their higher tax bracket is 9%, around 9%. And some state has flat tax rate, like Illinois, which has 5% flat tax rate. So, and then it varies for each state. And then again, it's like a federal, it's also, some state have progressive tax rate and some have the flat tax rate. One other aspect to, consider is when you, think about filing the state tax returns are, again, so on the federal side, so you get a big tax break to exclude part of your income under 911 code. So does all the state also allow, take that tax break? The answer is no. Not every state allow to claim for an earned income exclusion or housing exclusion. So some states like Alabama, California, Hawaii, Massachusetts. So these states does not allow to exclude your foreign earned income exclusion under 911 tax code. But some state, most of the state do allow. So if you have excluded some income on the federal, you can also exclude the same amount on the state as well. So once you meet the criteria on the federal, you can claim. And if you're filing a resident return, you can, like Virginia is one example, Illinois is another example. So if you're filing a full year return, so you can also take exclusion on that state as well. Okay, I think so we can move to the next slide. All right, so this may not apply for everybody, but we see a lot of clients who come to us and then not to understand if they have any of these requirement related to foreign aspect. But we will talk about what exactly is this first. If any expat has any ownership in a foreign corporation or foreign partnership, so that triggers additional filing requirement for them. And it depends, I think the tax rules are different depending on the amount of the ownership percentage what you have with that foreign corporation or partnership, or if that foreign corporation is a controlled foreign corporation. So so just to explain what is controlled foreign corporation, controlled foreign corporation is a corporation where more than 50% of the ownership is with the US citizens. That means if US citizens are controlling the foreign corporation, then that falls under controlled foreign corporation. So the rules are different if a foreign corporation is a CFC, which is controlled foreign corporation, and the rules are different if the foreign corporation is not a CFC and the ownership is between 10 to 50%. And the other owners should be, of course, foreign nationals. So in that case, let's say we'll talk about the first scenario where if an expat, let's say, invest or invest in any foreign corporation, and if its ownership is less than 10%, then there is no filing requirement. If it is more than 10% and up to 50%, so they have a filing requirement, but they can defer any profits from that, defer to pay any taxes on any profit. Let's say if he does not take any distribution like dividends or any other distributions, and if the profit is left within the corporation, so you just have to, there's no tax, impact in this scenario. So all you have to do is just file this tax forms from the compliance perspective, and then it's just for the disclosure. Again, this is very comprehensive form where you need to disclose most of the information about your foreign corporation, like the address, what the entity is doing, what business, what's your ownership, who are the other owners, and then the financials of the company needs to be also reported. But again, this all for disclosure. If your ownership is up to 50%, from 10% to 50%, and the other owners are foreign nationals. Again, the third scenario is if it is a CFC, controlled foreign corporation, and then meaning if you have more than 50%, or the other, the owners are US citizens. So in that case, the tax rules are a little different. So you will have to report and pay taxes on any company profit you generate. And even though if you don't give yourself any distribution, even if you leave those profits within the company, you have to pay taxes on that. Again, this is taxation limited to ownership or an individual, of an individual. So there will not be any taxation to the company per se. So same thing with the any ownership with the foreign partnership. The only difference is for foreign partnership, Form 8865 is filed, and for foreign corporation, any ownership with the foreign corporation, Form 5471 is required to be filed. Again, depending on your situation, which scenario you have, and you have to file and be compliant, file the right forms accurately, and then be compliant. And again, the penalties can be steep again, even for non-filing of these forms. So one thing to note is this is non-timely filing. This is not only non-filing, this is non-timely filing of business tax form can result in significant penalties. So let's say if you file this form late, IRS can penalize you like $10,000 per company. So for all the expat, the filing deadline is mainly the June 15, because they get the additional 2 months extension. And And let's say if somebody doesn't file the extension after June 15, and then they file the tax return and have this filing requirement of 5471, and then if they file after June 15, and then there's no extension in place, IRS can potentially penalize you with this penalty. And the non-filing, of course. So just wanted to, bring your attention to this. This is non-timely filing. And then again, so this, if you structure, we help. I mean, there are many. We get a lot of clients who comes to us. If they have any ownership, because most of the U.S. accountants, I mean, they may not be aware of the tax rules on the foreign aspects of, the filing for the expats. So they may not be aware of this. So they come to us, and then they discuss the situation, and then we end up amending the returns, to file the right forms depending on the situation to correct their tax returns. So let me just see if I have anything add to this. But again, so if the company is properly structured, so it can have a positive results it can take from the tax perspective. So I think we also assist, with our clients with structuring their company, just to ensure, they take advantage of some of the taxes. I think if any of you have something like, I mean, if you have any ownership in a foreign company, and then they want to discuss about their filing or how to, plan their filing, can always reach out to me, and then we'll definitely assist you, in optimizing their tax situation, and of course at the same time make them compliant with these filings. Okay, can we move on to the next slide, please? Okay. So now we regularly see these kind of cases where the expert, they come to us, they come to us and they say, okay, look, we have been living outside of US for all our life, or like 20, 25 years. We didn't understand our tax, obligations. What do we do in this case? We've never filed our taxes for the last 25 years, last 30 years. So what options do we have? I mean, we get so many different cases, similar cases. So for this section in general, I think we just added this one slide just to talk about more on this one, just to see if any of the participants falls into this category, then probably we can help them. This is mainly, so IRS also recognize that there may be many Americans who are abroad, and they may not be aware of their tax obligation. And then if they, it's not that easy also for them to go back and file for, let's say somebody has never filed the taxes all their life, or somebody has never filed the taxes in past 20, 25 years. It's not that easy for them, to go back and, fix their filings or file all the previous tax years and then become compliant. So this IRS recognized that, and then they came up with this program called Streamlined Filing Offshore, foreign offshore filing, and they made it, a little easier. And then the whole purpose is to, have those who have not filed their tax returns at all, they can come forward and file their tax returns and then become compliant. So under this program, I think I'll explain so what's the requirement of this program is just to file last 3 years of delinquent tax returns. And then the current delinquent tax return qualifiers, I mean, again, 2018, 19, and 2020. So you cannot include 2021 into this program because the 2021 is still current, and you have time until as many as until December 15th to file your 2021 tax return, provided you have all the extension in place. So 2021 cannot be included into this program. So the delinquent tax returns which qualify is 2018, 19, and 20. This is only last 3 years tax returns. And also they need to file last 6 years of foreign bank account report with their filing, the F bars. So again, the year which qualifies is from 2015 to 2020. The major benefit of this program is any prior year tax return prior to 2018 are no longer required to be filed or reported. So that will be waived, and all the penalties associated with non-filing or late filing of the annual tax returns and F bars are waived by the IRS also. As long as, again, it is non-willful. Non-willful, just to reiterate, somebody who were not aware, so they did not know what they need to do, they were not aware of their no filing obligations. So, I mean, we explained, we saw what could be the penalties for missing on F bar. So imagine, I mean, IRS is waiving all those penalties when you file under this program. And then once your tax returns and F bars, and there are a couple of other tax forms which goes along, with this kind of filing, called the certifications. So, and then once the tax returns is filed under this program, IRS takes about 8 to 10 weeks to process them. And then if everything is fine, they update, their account, the taxpayer's account with in the IRS system as compliant. So we have actually worked with many individuals who had who had never filed, or who had who would never file for various reasons. So we help them successfully file their delinquent tax returns and become compliant. So it's not that everybody can file in this program. There are certain eligibility criteria, so which needs to be looked at. And of course, if anybody, are in this situation, we can definitely help them, to successfully file in this program and then become compliant. Okay, can we move on to the next slide, please? Okay, so our last technical topics in this webinar is basically about the updates for this year. I think we'll start off with of course, the tax filing deadlines. So I think there's no change. It's last year was the pandemic year, so the filing deadline was moved to I think 2020 it was moved to July, and then last year it was moved to May. So this year, generally the first tax filing deadline will be April 15th, because April 15th this year falls in the weekend. So the first filing deadline is April 18th. Again, one thing to keep a note for the expats, although they get automatic 2 months extension, and their filing deadline is basically June 15th. But if there's any tax, if any expats anticipate to owe any taxes, that has to be paid by April 18th, so to avoid any interest, because IRS will charge interest if there's any tax due, and then the tax liability is not settled. Of course, the second filing deadline is June 15. This is mainly for the expats, for Americans who are living and working abroad. So they get automatic 2 months extension. They don't have to do anything to get this extension. It's automatic. The third deadline is October 17th. So you need to file an extension for this, to file by this date. So you need to have an extension in place. So 4868 is the form which needs to be filed to secure an extension. And again, it usually would have been like October 15th, but because I think the October 15th falls on the weekend, so that date has been moved to the following Monday. And of course, you can secure an additional extension until December 15, but that will be at the IRS discretion to approve. So you may or may not get approval for that extension. So it's better, to file your taxes. So you take care of your taxes before these timelines. And similar to last year, I'm sure, so IRS continued to, pay the COVID relief payments, stimulus payments. The first and second payment, the first payment was paid sometime in 2020, around from April onwards, May onwards, and then second payment January 6th of 2021, IRS started to pay second payment. The third payment, IRS started from March and April of 2021 onward. And then the third, anybody who did not receive their first and second payment, they were able to claim with their 2020 tax return. And similarly, this year also, you can claim a recovery rebate credit for the third stimulus payment if you've not received that payment. And the third payment is, of course, is $1,400 per household member. The first payment was $1,200, second was $600, and the third payment is $1,400. And now I think most of you must have already received, but if you have not received this payment, you can apply recovery rebate credit with your 2021 tax return. And there is an income threshold for this, which is almost the same how it was for your last 2020 tax filing. So for joint filer, if the AGI is less than 150,000, you get full amount. If it is between 150 to 60, it gets prorated. And if it is more than 160, so it is, you're not eligible. You won't be eligible to take this credit. For the other filers, for single filer, it is 75,000. If your AGI is less than 75K, so you get 75,000, you get full credit. If it is between 75 and 80, it gets prorated. If it is more than 80, then you're not eligible. For HOH, the threshold is 112,500. If it is less than 112,500, then you get full for you and then for your dependents as well. And if it is if it is more than 120,500, then you don't get anything. So that was about the third stimulus payment. And if you're not received one, of course, you can apply with your 2021 tax return. The other update for this year is the child tax credit payment. So IRS started giving out the child tax credit payment as an advance from July 2021 onwards. So they started giving based on the address on the tax return, the income, of course. But one thing to note is the one criteria you need to live in the U.S. For more than 6 months of the year in order to get this advance payment, or you would be eligible to get this credit. But if somebody, for expat, mostly this will not. This will not be the case. So unfortunately, you may have to, let's say if you have received any advance payment, depending on your 2020 tax filing. So you may have to pay it back, once the reconciliation is done with your 2021 tax return. The child tax credit rules will still be there. Just that the amounts are different this year. And then if you have received any advance, and then if you're not eligible for that credit, then you would have to, pay it back. That's about the advanced child tax credit for this year. Again, the amount has changed. The child tax credit amount has increased this year for the child under age 6. The credit is 3,600, and for the child who is between 6 to 17, so the credit is $3,000 this year. If you have received this advance payment, IRS must have already sent you a letter 6419, so that will give the information about advanced child tax credit for you. So which you need to use, for reconciliation purpose when you file your 2021 tax return. And talking about some of the deductions which are available for expats is, of course, I think we touched based on the foreign earned income exclusion. We also spoke about foreign housing exclusion, which all the expats would be eligible and can take. That will give a big tax break. And then other than the exclusion, of course, you will have the standard deduction to claim, and then we listed out. So the standard deduction is listed out here. 12,550 for the single filer. For joint, it is 25,100. Head of household, it is 18,800. So this is apart from the exclusion. So this standard deduction which the expat can look at to reduce your taxable income. And say if somebody were to be working in the US, they would be eligible to contribute to their retirement through 401k plans. But if somebody works outside of US for a foreign employer, of course, that option will not be there. So this is something which the expats can consider for their retirement, which is the IRA contributions. So one thing is you can contribute, for retirement. Plus, if you do it if you meet certain criteria, you can, get some deductions also. Again, you can contribute to, there are two programs. One is the Roth IRA and the other one is traditional IRA. Roth IRA is, of course, it has to be, to contribute, you have to, meet certain income threshold. But for traditional, you can contribute irrespective of your income. And then each of you can, each of the spouse can contribute about $6,000. And then if if you're above 50, then you can contribute $7,000 per spouse. And again, so deduction is, you can only claim deduction for the contribution to traditional IRA, provided you meet certain criteria again. So there's an income threshold also for that, the AGI. You need to look at the AGI to see if you can take any deductions. And of course, other than this, the credits such as, I think we spoke about child tax credit, that will still be there. The other dependent credit for somebody for any dependent over 17 years, the other dependent credit will still be there. So just the child tax credit amount is increased this year from last year. And then child care credit for child care expenses. So that has changed this year. It's actually a little generous amount now. So and then, so if you have incurred child care expenses while both the spouse are working or looking for work, so you can, there is some credits available which you can look to claim this year. Other than that, of course, the foreign tax credit was one big piece. It may not be applicable somebody working in this region, but if you're paid taxes in any other jurisdiction, the same income is being taxed. Of course, since the US taxes on worldwide income, the same income will be reported in the US tax return. So, and then you would pay taxes on that. So you can, to mitigate the double taxation, so you can take this credit if you have paid any taxes to any other jurisdiction. So that's about the FTC. And then there's other itemized deduction. Let's say if you have higher itemized deductions, such as mortgage interest, property taxes, medical expenses, charitable donations. If these are higher than the standard deduction, then of course you can take the higher of itemized or standard deduction to reduce your taxable income. So overall, if somebody, just to give a perspective, if somebody living in Dubai, for example, so they are eligible to claim own income exclusion of 108,700 plus the housing exclusion, depending on how much they pay. Let's say if somebody pays about 50 or let's say $50,000 in rent and utilities, they incur that much of expenses, then the additional housing exclusion leaving out the base amount will be 38,000. So 108,700 plus 38,000, which is about $146,000 plus let's say just to plus the standard deduction, let's say for single filer, additional 12,500 if it is joint, so you have additional 25,000. So just to add in on that, so it's 158,000, 159,000 roughly. So those many deductions you're eligible for. Plus, this is leaving aside the credits again, which would be eligible for, let's say for the dependents. And then you can also consider contribution to traditional IRA, and then that will give you additional, deductions that will bring down your taxable income and will, reduce your tax liability. Okay, I think we can move to the next slide. Okay, so just to talk about a little bit about us. So we are expat specialist firm and US expat specialist firm with a focus on expat basically, but we do provide service for everybody, irrespective of whether they're expats or somebody who are inbound to the US. But our focus from the Dubai office is mainly on the expats. So we have other than Dubai, we have offices in Houston, London, and Toronto. So we have, I think it's listed out here. So we offer a wide range of, tax compliance and advisory services. Some of the services are listed below. This is not the exhaustive list which I see. So we, assist with the U.S. federal income tax return preparation for expatriates, inbounds, and then state tax return preparation for expatriates, amended tax return preparation. Amended is something like correcting their previous originally filed tax returns. So we get a lot of requests for that because somebody would have missed the exclusion, or somebody would have missed the housing exclusion. Somebody may have not claimed full exclusion or credits or any other deduction that they will be eligible for. They come back to us because most of the US accountants, they really do not understand the expat tax issues. So maybe they may have reported the wrong income, or they may have underreported, overreported. So that we get different requests to correct the tax returns. So we help with the amended tax returns, and of course the foreign bank and Fatca, the FBAR and Fatca reporting. Of course, with the assistance with tax filings under amnesty program. So we, like I mentioned previously, so we assisted many filers with this, and then successfully, and become compliant. And of course, the tax planning, we also review the expatriate contracts. So any issues, federal and state residency issues. Also the, sorry about that. So IRS audit support, assistance with tax notices, penalties abatement. So we help with that as well. And of course, the other advisory services. So our focus is mainly on the tax optimization, not just the preparation, because so we mainly focus on the optimizing the situation of the expatriate, and then file optimized tax returns for them. So that's our main focus. So we plan around that. We invest in building relationships. So that's why mainly our clients stick with us for long. Okay, so just one other thing I just forgot to mention, because like I said, this is not the exhaustive list. Some of the other services, it's exit tax filings also we do. Somebody who's renounced the US passport or green cards, long-term green card holders, so we assist them with their filings, and then exit tax filings too. We offer competitive pricing as compared to other firms, while of course maintaining the quality service or providing high quality services. So we recommend best filing depending on their situation. So we optimize fully their tax situations and help them file optimized tax returns. And our accountants are ex-Big Four trained, and then with over 75 years of experience. Just to, if you, can we move to the next slide? And these are our, okay, this is the contact details. So you can always reach out to us, reach out to me or my colleague whose details are also listed here with any questions you may have regarding your tax filing. So we'll be more than happy to help you out and with your US tax filing, irrespective whether your current filings amended, or maybe if any corrections are required, or any delinquent filing needs to be done, amnesty, current year filings, all the other issues which you may have. I think we can always, specific issues we can address to that. So you can note down our details, and then you can reach out to us anytime you may have any questions. And these are our service offerings. You can just go within this pretty much. I think it talks about who we are, what do we do, what kind of services, where are we specialist, what area is our specialization, what services do we provide, and then of course why you need to, our pricing, it's not listed here, but again, it depends on the situation. Okay, with that, I think I'll open for the question and answers then. It's time for a Q&A session.
Yeah, shall I take the liberty of reading out the questions? Can I do that, Afan?
Sure.
All right, very good. Well, let's see, wait a sec. All right, there's one from Ginger. It's our employer provided benefits like tuition payments for children, moving costs, transportation allowances. Is all of that considered part of income that you've got to report as, I guess, income on your 1040s?
Yes, as per the US tax rules, any cash or non-cash allowances which you receive from your employer are required to be reported on your tax return. It is taxable. And
it would also be, you could also claim it on the foreign earned income exclusion, right?
If it's, yes, all this will, yes, all this will part. So that's, of course, like I said, rule of thumb, everything, it's tax, everything needs to be reported first, and then whatever exclusion you're eligible for. So this is part of exclusion also, so you can claim as long as you're, you max out on the exclusion.
Okay, here's one. Let's see. here's someone who owns more than 50% of a Saudi company, and this person has to pay 20% corporate income on the net profit. The Saudi tax authorities do not allow owners' salaries and bonuses to reduce the company's tax basis. Okay, they're not deductible, I guess, from the corporate tax. Therefore, this taxpayer is double taxed on the salary and bonus in both Saudi Arabia and in the USA. Can this taxpayer use the foreign tax credit to get rid of this double taxation? And does this taxpayer owe anything else in taxes to the IRS because they have a company in Saudi Arabia? Couple questions in there, yeah.
Yeah, so there are two aspects of this question. So one, I think the first aspect is about claiming the tax credit. Of course, if you have paid taxes to Saudi government on your, this income, then you are definitely be eligible to claim credit to avoid the double taxation.
Yeah. But it's a Saudi corporate tax, not personal tax, I think.
Yes, because again, the profits from the the company is also taxable if it is more than 50% on the individual tax return, on his individual tax return.
Okay,
so if you paid taxes there, so you can claim credit also to mitigate the double taxation. And I think the second, just missed out on the second aspect.
Second question, I guess, is does the person have to make a filing because they own 50%, more than 50% of a Saudi company?
So other than, from the filing perspective, yes, you'll have to, file the 5471 form as well, along with your tax, and those called the business tax forms, along with your individual personal tax return. So with, reporting your ownership, your company details, like I said, other owners' details, the financials of the company, Saudi company, everything needs to be listed out. So it's a very, very comprehensive form that needs to be filed along with your personal tax return. It goes along with the personal tax return, but it's a separate whole, the very comprehensive form.
Okay, yeah, well, like I guess so many of us have to file multiple forms along with the 1040. Yeah. Let's see, I've got a question, and it's, what about an overseas, what if you move overseas in the middle of a tax year? When can you start, claiming the foreign earned income exclusion? Like you move here, I moved to Dubai in June, then what happens?
Yeah, so let's say, for example, let's say if you leave Dubai in June of 2021, okay, so we're doing your 2021 filings, okay? So you can claim partial exclusion. So let's say if you move back in, let's say, mid of June or end of June, so for the 6 months of that year, so you will still be eligible to claim exclusion. Again, there could be, where situation where, let's say if you have not visited US, prior to, in the last 12 months, prior to moving back to the US, then you are eligible, you can get some additional exclusion also. Not only that for the last 6 months, but if you have not, have visited US for those 35 days, which you're eligible for, so you can get some additional exclusion. But just to answer your question, if somebody moves back in the middle of the year, middle of the tax year, they are eligible to get exclusion, the prorated exclusion for the period where they were where they were outside of the US.
Okay. I thought you could change your tax year and make it longer, or more than 12 months or shorter than 12 months when that happens.
So I think the best thing what to do is for anybody who is moving back or starting or moving out of US in that year, so it's better to use the PPT. I remember I think in one of the slides we discussed the PPT, physical present test. So that test actually gave additional exclusion basically, because depending on whether you use your, if you did not travel to US for 12 months period, and let's say if you move back in June, technically you should be getting only the exclusion for 6 months. But if you've not utilized those 35 days in the years, if you continuously were outside of US only, then you are, there's some, it's called slide days, the additional slide days, exclusion for additional slide days. So you get some additional exclusion for that one particular month.
Okay. I see Faris El Hadri has his hand up. Can you unmute yourself and ask your question?
Yes, sir. Thank you so much. I have a question. I am an Omani living in the U.S. on E2 visa, E3T investors visa. I've been filing my U.S. tax return, including the state and federal. But this year, my CPA requested me to file for to claim all the foreign income. So I am not a U.S. resident, but she mentioned based on the IRS rule, I'm considered a U.S. permanent resident. But the E2 does not allow us to become a U.S. permanent resident. I need an advice on this.
Okay, so as long as you're not a U.S. And how many days? It depends on how many days you spend in the U.S. And what my understanding is, you're not a U.S. person. You're not a U.S. green card holder. You just have a investor visa, and then you spend how many days in the U.S.?
Right, I've been on an E2 visa since 2017, and I've been in the U.S. sometimes 2 years, sometimes 1 year. So most of the time since 2017, I've been in the U.S.
Can you, be specific as how many days you spend? Let's say, for example, if you were to talk about 2021 tax year, how many days you spend in the U.S.?
2021, I spent more than 180 days.
Yeah, so in that case, we'll have to look at, there are, some test which needs to be looked at. It's called substantial present test. Okay, so we'll have to look at how many days you spend in the US in the current year, how many days you spend in the prior, previous 2 years. And depending on that, so we'll have to see what return you need to file. So I think we'll have to have a discussion on this to understand your situation in a broader way, and then we can recommend you what is the best possible filing you can do in that situation. So I think if you have, if you can note down our contact information, you can reach out to me, in person, and then we can discuss your situation in detail, and then we can recommend what is the best tax filing for you for 2021.
Sure, I will get from OABC. I will contact them and get your address. I do appreciate it. Thank you so much.
Sure, Faris.
Yeah, thank you.
All right, I've got just a few more questions before we are kind of out of time. If you've got time, Afan.
Sure.
All right. There's a question here about the bank accounts. Do we have to report bank accounts that are not in US dollars? And if we have to report like dirham or Saudi riyal accounts, what exchange rate do we use?
Okay, so IRS every year post the yearly average and end of the year rates. For bank accounts, you need to use the end of the year end of the year rate, which IRS publishes every year. So you need to convert your the amount in USD and then report on your foreign bank account report.
Okay, but the IRS publishes the rate they want you to use, right?
Yes.
Okay, all right. All right, here is someone who didn't collect stimulus checks for, I guess, going back a couple of years. Do you lose the right to are you gonna lose the right to the money, or can you still file and claim them now? When do you lose the right to claim those stimulus checks? Okay,
so my understanding about this question is this person has not received any of the stimulus check, okay, which IRS issued, okay, and then he's not maybe looks like he's not filed his tax returns last year as well. Oh. In that case, it's not that you will lose this. If the IRS has sent you a check and then if you have not received, that's a separate aspect of it. You have to file a separate form, which is 3911, and you need to request IRS to pay that back to you. But if the IRS has not sent you any check, then of course you can file your 2020 tax return to claim the refund for the first and second stimulus check, which is $1,200 and $600. And then you can also file 2021 tax return to claim the third payment of $1,400.
Okay. Oh, so you just fill out the money that you should have got as a partial payment of your taxes when you file the return.
I mean, so yeah, you just need to file a tax return showing that you are eligible to claim to receive the stimulus, but you've not received any check from them. Instead, you are claiming a credit, the recovery rebate credit, which IRS allows to,
Okay, I understand. Yeah. All right. Okay, here's a question. If one spouse, I guess it's spouse, one is a non-US, non-resident in the US, and the other is a US citizen, does the US citizen then file married filing separately? How do they file?
Okay, to start with, the US person ideally needs to file an MFS return. But again, if the non-resident spouse has an ITIN, or he has an option to file to make the non-resident spouse as a resident for tax purpose only, can file a required election and make her a resident for tax purpose and file a joint return to claim additional tax benefit, because joint filings will, as compared to MFS, gives better tax benefit in terms of tax rates, plus the deductions, credits, everything. But one thing to note here, for somebody as a non-resident, to be included on the US tax return, he or she needs to have the tax identification number, individual tax identification number, that needs to be applied at the time of filing of the tax return. If that happens, then the tax return cannot be e-filed. It has to be manually submitted, or it needs to be mailed to the ITIN operation department.
Oh gosh, okay. All right. Do you help Expat Global Tax with trust fund creation for like inheritance tax matters?
We don't assist with creating any funds. It's just that we assist with the compliance aspect of it.
Okay.
Like the filing requirement, so the trust, the creation of that has whole sort of different process that needs to be followed. And then once it is set up, then we can assist with all the compliance aspect of it.
Okay. And here's a new question for taxpayers who itemize. Can the taxpayer claim credits on home office costs like utilities? And can they claim costs that are not relocation costs that the employer does not reimburse?
Okay, so starting, I think the new law which came into effect from 2018 onwards. So on the itemize, you cannot claim the unreimbursed employee expenses.
Okay. But home office costs you can claim, can't you?
That also, if it is, no, that's also not. If it is on the itemized deduction side, no, it's not.
Okay, car payments?
You can claim home office if you have, if you are a self-employed. On your self-employment tax form, you can claim home office.
Okay. And I guess our friend who is waiting for his stimulus checks has a follow-up question. Is there a way to reach the IRS, or do you have to file it on your tax return? How do you, the taxpayer who's waiting for his stimulus checks still, can he phone the IRS and find out, or is there another way to contact them?
Okay, so now that depends on if the IRS has sent you a check, it must have gone back. Okay, so in that case, you can file, there's a specific form which you can file and have those checks returned and have the IRS to pay you back. But if they have not sent you anything, then better to file a tax return, provide the bank account information, let the IRS know that you are eligible for the stimulus payment which you did not receive, and then so you're claiming the recovery rebate credit. If you have a US bank account, it's better to use that, so the stimulus payments can go straight to your bank account rather than IRS having mail out the checks. Yeah,
definitely better than mail. I totally agree with that. Okay, Afan, I think we've come to the end of, just one more question. This is on the taxpayers of different nationalities. When when can the U.S. citizen file as head of household with a non-U.S. resident spouse? Anytime? I guess they want to file married filing jointly, but one of them is not a U.S. taxpayer.
Okay, so in that case, if they have a dependent to claim, then they can either file a head of household. Okay, and if that will give better, of course, that will be better filing status as opposed to married filing separately. And even better, it will be they file joint, but provided again, we'll have to look at if the non-resident spouse also works, and if she has other income, then it may not be good. It may not be a good idea. So if she's not working, if the other spouse is not working, doesn't have any income, then you may consider, taking an election and file a joint return to take, advantage of other, tax benefits. And then, like I said, one of the requirement is the non-resident spouse needs to apply for individual tax identification number. So that has to be filed along with the tax return. Gotcha.
Okay. All right. Well, I think we can close it off there. I think we've got to everyone's question, Afan. So, thank you so much. Thank you, Afan Khader, and thank you to Expat Global Tax for spending 90 minutes with us and telling us all of these things about the upcoming tax season. And like everyone, I think, has your contact particulars if there's any follow-up. And maybe we can see you again next year. Because I'm sure that, if we're still here, we'll still be paying taxes. So thank you very much. Anything else to add, Shirat?
No, just thank everybody, and post-event email campaign will be sent to all the attendees with the copy of the slides and the recording that might come tomorrow. Okay. Thank you all for attendance.
Thank you, everybody. Really appreciate it. Thanks, Afan.
Thank you, Charles, and thank you all the attendees.
Thank you.
Thanks. Thank you.
Thank you.